All right. Hello to everyone. I hope my voice is audible. We are going to start with the session shortly. Just give me around 5 minutes so that maximum participants can join us. Okay. So in 5 minutes time, we are going to start with the session, and you all are aware about the session agenda. So let's wait for 5 minutes and then start. Okay. So I hope my voice is clearly audible to everyone. Screen is visible to everyone. There might be students who are not the regular students, and then there can be students who join me who are regular students. Okay. So I welcome each one of you to today's session. We are going to wait for around probably 2 or 3 minutes before we start with the session. And we are going to discuss the most recent attempt past paper, okay, which is your June 2024 past paper. Okay, this is our agenda. We are going to discuss June 2024 past paper, and we are going to discuss the secret sauce. Okay, just waiting for 3 more minutes so that maximum students can join, and we are at the official time to start the webinar. Okay, I can now see that the students have joined, and okay, first I will like to discuss the secret sauce with all of you as well. I hope you all have downloaded the secret sauce document. Have you guys downloaded the secret sauce document? This is the secret sauce that you are supposed to do in last 15 days, okay? Not before last 15 days. This is the document that you will do in last 15 days or maybe 20 days if you are done with all the content that I have given to you. It is a Google Drive link, past paper analysis, some old past papers. Then there are some documents that you can download, you can follow. And then there are important webinar and live sessions. And after that, you have a list of important questions. Okay. There are 16 past paper questions from 2007, 10, 11, 11, 12, 14, and so on. You can see it on your screen that you are supposed to do. Okay. Then there are some important pages which you will do, and there are some hot topics and some links to important technical articles. So this has been provided to all of you a lot of times, and once again, it is being shared over here. I will appreciate if you all make sure that you all have this document. Whether you are a regular student or not, you must have this document with you, and you must check this document. Okay. All right. Now coming to the agenda. Our agenda for the day is that we solve June 2024 past paper. There were 3 questions. Question number 1 was relevant to hedging area. Question number 2 discussed investment appraisal and BSOP model. And then there was question number 3, which was about mergers and acquisitions area. Okay. So we are going to try and discuss all the 3 questions and do maximum that we can in the available time. I have already shared with all of you the list of relevant, the questions and the files so that you can look into them. I hope you all did look into the question and read it once, but let's read it and start with question number 3. So this is game changer day number 1, and we are going to start with question number 3. This is June 2024 past paper question number 3. Okay. And this question is about mergers and acquisitions. Are you all ready for this? Okay. So if we read the question, it says Garnet Company. Are we all ready? Are you all ready? Okay. So this is June 2024, past paper question number 3. The question states that Garnet Company was established 12 years ago to provide courses for accountancy qualification. A major reason for Garnet Company's success has been that it has been quicker than its competitors to develop profitable e-learning course packages. Okay. So one key thing to note over here is that it is an old established company and specializes in e-learning. E-learning. Okay. Apart from its founders, Garnet Company's staff turnover has been quite rapid. Some staff have not stayed long either because they are ambitious staff who have made a contribution but sought career progression elsewhere, or because they have been quickly dismissed. So there are two key points. There are two takeaways from this first paragraph. Number one, positive takeaway. Company is an old established company and it is specializes in e-learning courses. And then a negative takeover, that is the staff turnover is really high. People come, join and leave. Okay. Garnet Company was listed. It is a listed company, listed 3 years ago on its country's stock market for smaller companies. A key thing to highlight. What is the key thing to highlight? Is it listed on the main stock market? Is the company listed on the main stock market? No, it is listed on a smaller company's stock market, which is a partial or a smaller segment. Okay. It has since developed governance mechanism in compliance with the stock market regulations. Some of its non-executive director and investors feel that its culture is still too informal for a listed company. Still too informal for a listed company. Now, if we highlight the points in the first two paragraphs, company is an old company, company specializes in e-learning, staff turnover is high, it is listed, but on a smaller companies, exchange or market, it has an informal culture. 5 things, okay? 5 things. Garnet Company's executive director are looking to expand the company. Now directors are looking to expand. There are 2 ways to expand your company: organic growth, and the other method is to acquire some other company. Garnet Company's executive directors are looking to expand the company into new areas of training where there is potential for cross-selling courses and further opportunities for development of e-learning packages. Okay. So now what is happening is that we are going to expand. We have decided that we are going to expand our operations. We will go for towards expansion and maybe we can acquire some other company as happens in a mergers and acquisitions question. Are we all together? Okay. Garnet Company's board has identified 2 possible target companies. Okay, we always remember that there is a company known as acquirer and there is a company known as target. Acquirer is the one that is acquiring another company and target company is the company that is going to be acquired. Are we all together? Now in this question, there are 2 different companies under consideration. You will either acquire Pilser company or you will acquire Mahyu company. There are 2 possible companies and you will acquire one of these 2 companies. Pilser company situation. Now we are given information about Pilser company. Pilser company has offered classroom courses for legal qualification and professional development courses in areas of law, tax and regulation for over 30 years. What is the key difference between these 2 companies? What is the key difference between Garnet company and Pilser company? Can you guys identify the key difference between these 2? Guys, I need participation in the chat box. Please make sure you are muted and participate in the chat box. Okay. So what is the key difference? The key difference, yes, exactly. One company specializes in e-learning and the other specializes in classroom teaching. This is a difference. This is a major difference. Pilser company has offered classroom courses for legal qualification and professional development courses in areas of law, tax, and regulation for over 30 years. Over 30 years. So actually what is happening is that the target company is an older company. Target company is much older than the acquirer. Pilser company is also listed on the smaller companies stock exchange on which Garnet company is listed. Both are the listed companies, but they are listed on a small exchange. For a long time, Pilser company was a leading company in the area of legal training, and its directors and some staff have been with the company for most of its life. The company has a well-defined management structure. Well-defined management structure. Now, is there any cultural difference between both companies? Can you guys identify a cultural difference between both companies? In case of Garnet Company was there a formal, well-defined management structure and culture in the Garnet Company, the acquirer, or no? It was still informal, correct? The other company was informal. The other company was informal. When we talk about both the companies, there is a cultural clash. One company has an informal structure and the other has a well-defined structure. Now, I am emphasizing these points because you are supposed to write these points in your theory areas. I hope you all are aware that you need to write them, okay? Then it says, with seniority and classroom experience being important attributes required for promotion. However, in recent years, revenue and profit growth has been slower than Garnet Company because of increased competition and Pilser Company's failure to develop effective e-learning products. Now, why Pilser Company is not progressing? Two reasons. What are those two reasons? What are those two reasons? Reason number one, high competition. Competition has increased. Reason number two, it is not able to develop properly in e-learning area, whereas the acquirer specializes in that particular area. The following recent financial data relates to the two companies. Now you have financial data of two companies. You are given with the number of $1 equity shares. So Garnet Company has 80 million shares, Pilser Company has 100 million shares. Then there is a share price. Now, what is a share price? Can someone tell me what actually is a share price? What is a share price? Share price is the value of one single share of a company on books, records, what? In the exchange, okay? So if we have share price of Garnet Company and we have number of $1 shares of Garnet Company, if we multiply both of these together, we will get the market value of the company as per stock exchange. As per stock exchange. Now the value as per stock exchange, may reflect the true value of the or the true potential of the company. The company might be overvalued. The company might be undervalued. Anything can happen. Are you guys with me? Do you guys understand this? The company might be overvalued. The company might be undervalued. This is the exchange value. The stock exchange value moves up and down depending upon the demand and supply as well. If everyone buys shares of a particular company, the share prices are going to increase. Then you are given free cash flows to equity. Now, free cash flows to equity, you all must remember that there are various valuation techniques for a company. You can value a company based on free cash flows to equity model. You can value a company based on free cash flows to company model. You can value a company based on a PE ratio model. You can value a company based on the market valuation model. You can value a company based on NAV, net assets valuation method. So there are various methods, and over here, it seems that the question is interested in the free cash flows to equity model. Now, can someone tell me what does free cash flows to equity model state? How do we calculate the market value of a company if we talk about free cash flows to equity? What is the relevant discount rate that needs to be used? Do we use weighted average cost of capital or do we use KE, that is cost of equity? We will use cost of equity. We will discount the future free cash flows to equity and bring them today, and you will get the market value of all the shares. Do remember that you don't have to use the weighted average cost of capital. Weighted average cost of capital is used in case of free cash flows to company. Are we clear? There is a difference between both of these methods. Are we clear? There is a difference between both of these methods. So over here, we are going to use the free cash flow to equity model. Additionally, Pelser company's equity beta is 1.4 and its asset beta is 1.2. Now tell me the difference between equity beta and an asset beta. What is the difference between equity beta and asset beta? Asset beta reflects the business risk of a company only and only. Equity beta reflects business risk as well as financial risk, both risks together. Financial risk depends upon the debt to equity ratio, gearing, and things like that. Business risk is inherent in the type of business a company is conducting. So we have two things. One is known as beta equity and the other is known as beta asset. They both are linked with a particular formula. Then it says the expected growth rate in Pelser company's free cash flows to equity is 1.5% per year. The cash flows are going to increase every year. The current risk-free rate is 3.8% and the market risk premium is 8%. Okay, one important thing. I think there is a model that we are supposed to use to find cost of equity. What is the name of that model? What is the name of that beautiful model? Okay, capital asset pricing model. Well said. Capital asset pricing model is the model that we use to calculate the cost of equity. Now, can someone tell me, do we use beta equity in the model? Do we use beta asset in the model? Or it depends upon the scenario? If it depends upon the scenario, what is the scenario? When do we use beta asset and when do we use beta equity? There are two cases. Sometimes we use beta equity in the model and sometimes we use beta asset in the model. Excellent, Pratna, excellent. When you are doing an adjusted present value question, when you are doing an APV question, when you are solving a question based on adjusted present value, you initially assume that there is 100% equity, there is no debt, there is no gearing, there is no financial risk. So in case of adjusted present value questions, you use beta asset in the capital asset pricing model and calculate cost of equity. Because your initial assumption is that there is zero debt. And if there is zero debt, there is no financial risk. And if there is no financial risk, beta equity and beta asset are same. This is your assumption in adjusted present value questions. But normally in the questions of mergers and acquisitions, since it is clearly mentioned that the company has a beta equity, you need to take that factor into account. You need to establish the fact that yes, there is some equity and there is some debt and we need to consider that. Are we all clear? Now the capital asset pricing model formula applied over here will be 3.8%, which is your risk-free rate of return plus equity beta into, will I take difference of 8% and 3.8% or directly write 8%? Tell me quickly. It is your revision time. I will be like this in the entire session. I hope you like. Okay, we will directly take 8%. Why, sir? Why will we take 8%? We will take 8% because this is risk premium. Now, again, there are two things. Sometimes you are given with the market rate. Sometimes you are given with the market rate. For example, if in this question you were given with the market rate might be, market rate is equal to sum of premium and the risk-free rate. So 8 and 3.8 added together will give you 11.8. Sometimes you are given the market rate of return. In that case, market rate of return minus the risk-free rate of return will give you the risk premium. And in other cases, you are directly given with the risk premium. Are we clear till now? Are we clear over everything? I hope that things are clear with all of you. I hope I am able to explain everything to you. Are we clear till now? Are we clear till now? Okay. So you have to be very careful in your exam papers. Number one, in this question, we will not use beta asset, we will use beta equity. Number two, we are going to use the market risk premium. We are not given with the market rate of return. Yes, if market rate of return was given, we will take the difference of the market rate of return and the risk-free rate of return and then take it in the capital asset pricing model. So can someone tell me what is the cost of equity right now? Is it 15%? Is it somewhere around 15%? Please confirm it to me. Okay. All right. Excellent. Excellent. Let's move on. Let's see what is written further. If we move down, if we scroll down, it then says Garnet Company's finance director believes that the acquisition could generate annually $9 million of free cash flow synergy. Okay, one more important thing. Hey, everyone, one more important thing. Sometimes synergy is given in terms of market value. Sometimes synergy is given in terms of cash flows. I repeat, sometimes synergy impact is given in terms of market value, and sometimes it is given in terms of cash flows. What do you think? Is it free cash flow synergy, or is it the market value already? If it is free cash flows amount, you will need to incorporate it while doing the total free cash flows working. So over here, it is stated that the synergies are given in form of free cash flows. It is not a market value. It is not the end or the final result or the last value. It is the free cash flow synergy. The question is about to tell you that the free cash flows to equity are going to increase by 9%. The free cash flows to equity are going to increase by 9%. Sure, I can repeat. Over here, it is written free cash flow synergy. Over here, it is mentioned free cash flow synergy. If we talk about free cash flow synergy, it means that the 9 million amount is the addition that will happen in the free cash flows. Okay. In itself, it is not a market value. And sometimes the question will state that due to synergy, due to acquisition, the total amount or the market value of the company will increase by 9 million. So both things are different. Over here, we need to discount 9 million. We need to do the discounting. Okay. So this is in terms of free cash flows. Okay. Okay, then one interesting thing, this is something developed by the examiner, and sometimes in the past it was also asked. It says the multiple of free cash flows to equity is 8%, or sorry, 8 for Garnet Company before the acquisition takes place. Okay. I repeat, the multiple of free cash flows to equity is 8 for Garnet Company before the acquisition and can be assumed to increase by 5% for the combined company if the acquisition takes place. Now, sir, what is this multiple of free cash flows to equity? By multiple of free cash flows to equity, we simply mean that if you multiply your free cash flows to equity by this multiple, you get the market value of equity. Let me once again repeat, if in any question it is stated that this is a multiple of free cash flows to equity, so the multiple of free cash flows to equity means that you simply multiply this 8 with your free cash flows to equity, you will get a market value. So in a question, when you are given a multiple, in order to calculate the market value, the formula is free cash flows to equity multiplied by the multiple. Free cash flows to equity multiplied by multiple. Okay. This is something that the examiner has introduced in some recent past, but it is not a difficult thing. It is a very easy thing to remember and retain. Simply, what you have to do, free cash flows to equity multiplied by the multiple factor that is given in your question, and you get the market value. Are we all together? Are we all together? I repeat, are we all together? All right. Let's move on with the same energy. So we know that currently this multiple is at, how much? It is at 8. And then it also says that if the acquisition takes place, this multiple is going to increase by 5%. The question also states that if Garnet Company acquires Pilser Company, this multiple is going to increase by 5%. Now, if the multiple is going to increase by 5%, what does that mean? the new multiple after post acquisition, after acquisition takes place, will be how much? 8.4, correct? It says that if the acquisition takes place, the multiple of it is going to increase by 5%. Moving on. The finance director believes that Pelsar company shareholders would at a minimum accept a premium of 14% on the current price of its shares. Okay. You have a finance director, and the financial director believes that when you are going to buy Pelsar company, their shareholders will want you to pay something extra. They will ask you to pay 14% extra over the current price of its shares. Okay. So for example, if current price is 5.40, they will ask you 14% extra. Are we clear? Although she thinks that the shares may be overvalued at the current share price and that a free cash flows to equity valuation should be used instead. Now, this is one twist, turn, and an important line in your exam, because if you miss this line, everything goes wrong. What is that line? Finance director says that they will have to pay 14% over the current price of the share, but they also emphasize that in order to value the company, in order to take out the valuation of the company, you will not use the market value of the company, but you are going to use the free cash flows to equity valuation method. Okay. So under free cash flows to equity valuation method, you have to discount the future cash flows using cost of equity to find the value of the company. Now, this was a very important line. Although it is again emphasized in the question as well, in the requirement, but if someone misses this line, they may turn up doing everything wrong. So this was a very critical point mentioned over here, that when you are valuing this new company, you will use the free cash flows to equity model. Now your share price model can give you a different valuation, and the free cash flows to equity model can give you a different valuation. Okay. Are we all clear? You all know there are different methods to value a company: P ratio model, free cash flows to equity, free cash flows to company, EPS model, and so on. And every model gives you a different value. So over here, it is clearly stated which method you have to use, and you have to be very careful in the exams. So one thing is that they are going to ask you 14% premium. Then it says Garnet Company's board has set a target of 60% of the gains on acquisition accruing to its own shareholders. Now, what do you mean? What are the gains on acquisition? What do you mean by gains on acquisition? And Garnet Company wants that 60% of these gains must come to their own shareholders. Excellent. The value of synergy. Value of synergy. For example, there is an acquirer, there is a target. Acquirer's market value is 2, target's market value is 2. They know that if both merge their operation, their total value is going to pop up and increase by 1 in itself. So this is the gain. This is the 2 plus 2, 5 synergy that they are enjoying. Now the directors think that 60% of this particular synergy must be given to their existing shareholders. Okay. Then defense strategies. What are defense strategies? Can someone tell me what are defense strategies all about? Now, sometimes the target company board of directors don't want their company to be acquired by someone else. So they put fences, they put, you can say, barriers, blockage to avoid the takeover. And there are different methods to avoid those takeover. I hope you all have read the 67 pages, the famous 67 pages booklet. I hope you all have read that. How many of you are not connected with me on my WhatsApp? If in case you are not connected, you don't have the secret sauce, you don't have the Google Drive link, you are not added into the WhatsApp group, you need to be connected with me. And once you are connected, I am going to share all the content with you. Do we have someone who is an outsider, who is not like the regular student? Because all regular students are actually connected with me. I don't know if there is someone who is from outside the normal classes, not enrolled. Is there any student who is not enrolled for the course and he is not added to the group? If this is the case, right after the class, you have to make sure that you WhatsApp me so that I can facilitate you. My WhatsApp number is +971 58 506 8907. Okay, +971 58 506 8907. And you all know plus means 00, correct? So it can be 00971585068907. You have to WhatsApp me your complete name so that I add you to the group and share relevant content with you. There is a 67 pages booklet which discusses different defense strategies. Let's see what defense strategies this particular question wants to test. Okay. All right. It says, yes, you are right, Suman. Pilsner company's directors are aware that Garnet company may be interested in acquiring their company. Now, the directors of the Pilsner already are aware somehow that there is a Garnet company and they are going to come and acquire us. The directors will not welcome a bid from Garnet company as they feel that it will result in major changes to how the company operates and threatens their own jobs. Obviously, if someone acquires another company, they will place their culture in place, maybe their directors in place, their senior management in place. So the existing management, senior management and directors of Pilsner company may face challenges. They may lose their job and something else. Okay, similar things. Two possible defense strategies have been suggested if Garnet company makes a bid for the company. Now, what is happening is that Pilsner company's directors have suggested that we will go for these two defense strategies. There are many defense strategies, but they are going for these two defense strategies, and they will use these defense strategies to make sure that Garnet company does not acquire them. Are we clear till now? I need energy and participation from all of you as well. If you are alone in the room, start shouting. Okay. Moving on, one is seeking an alternative, more welcome bidder for Pilsner company. Okay, so the first strategy is more welcome bidder. What does this mean? This means that if Pilsner company is going to be acquired by Garnet company, they find someone else who will acquire Pilsner company, who is their friend. So you find your friend, okay? You are actually, the directors are trying to find someone who will listen to them, who will agree to their terms, who is easy to like the cultures match, and they know that if XYZ company, they find XYZ company to acquire them, their jobs will be protected. So this is what is happening over here, that you are finding someone else who can acquire you so that your jobs are protected. You know your friend will acquire your company instead of Garnet. So your roles will be protected. You will stay on the seats. You will stay on your jobs and the roles and the post you are enjoying right now. The other is Pilsner company making a counter offer to acquire Garnet company. Wow, counter offer. This is also one defense strategy that the target acquires. For example, if someone comes and tells, hey, I want to buy your company, you tell them, okay, I will buy you instead. Okay. Yes, Pac-Man defense. Excellent. I hope you all have read the 67 pages book. I can see that you are mentioning White Knight, Pac-Man defense, but you see in the exam paper how easily they are mentioning the things. They are not using the technical terms. Okay. Yes, if you memorize the names and write them in your theory, you can go for a national position. So obviously, it will give you a edge over others. Obviously, this is very obvious. No second thought in this. Are we all clear? Okay, so this was all about Pilsner company, the first company under consideration that Garnet is going to acquire. Then there is one more company. Mario company is an unlisted company, which is smaller than Garnet or Pilsner. Okay, so Garnet and Pilsner are not very huge companies. They are not listed on the main market. They are listed on a smaller market. But Mario company is an unlisted company. It is not even listed. So it is a much simpler, smaller company probably. The company was founded 5 years ago by husband and wife, Richard and Katie, who own 80% of its share capital between them. So I believe this company in the first two lines looks an easy target because you just need to talk to two shareholders and get 80% of the shares with you and then only 20% left. In case of Pilser company, Pilser was a listed company. There will be more requirements. You will need to invite the shareholders. There will be dispersed shares. Agreed? The company provides professional development training in areas such as management and personal skills, also training in legal requirements such as health and safety. So it is well diversified. Management, personal skills, health, safety. Okay. Richard and Katie have recruited lecturers whom they feel will work well with them and have given lecturers considerable autonomy. Lecturers considerable autonomy in delivering courses and gaining new work. Now tell me, the work culture of Meriu is more like Garnet, correct? Garnet has an unofficial or a very soothing or you can say, if you read over here, informal culture, correct? Informal culture. So when you give autonomy to people, they feel more informal. They make some decisions on their own. They do things on their own, correct? So right now, what is actually happening is that Meriu company seems to be culturally more aligned, correct? And probably an easy to acquire company. It is also unlisted. There are only two people. Are you all understanding these facts? Okay. Further, it says the company provides. Okay, we have read this. And then it says that Richard and Katie have recruited lecturers whom they feel will work well with them and have given lecturers considerable autonomy in delivering courses and gaining new work. The board consists of Richard and Katie and two other lecturers. Wow. But in practice, Richard and Katie make all major decisions themselves. So there are at maximum 4 people you need to talk with. Richard, Katie having 80% shares and 2 very good, popular, famous lecturers. So there are 4 people only. There are 4 people only instead of a listed company like Pilser. Okay. So over here, it seems that it is an easy target to acquire. Many companies' revenues and profits have increased in the last 2 years at a greater percentage rate than either Granite company or Pilser. It is also a growing, profitable company. In case of Pilser, Pilser was struggling, correct? When we talk about Pilser, Pilser was struggling. But in case of Meriu, it seems they are not struggling. Garnet company or Pilser company, Meriu company has developed a limited number of computer-based courses, but has had insufficient funds to develop significant in-house e-learning capabilities. Okay, now one more important thing. Do you remember the types of synergies? Revenue synergy, cost synergy, and financial synergy. Sometimes a company has ideas or they have the potential to grow, but they don't have the relevant funds with them. So maybe Garnet company can put in some funds, maybe. And also one important thing is that Garnet company is good at e-learning, so they can help them and there will be more synergistic benefits probably. Correct? Okay, Richard and Katie have indicated that they are willing to discuss a bit with Garnet. Amazing. The target company is itself a willing and a welcoming company. At Pilser company, there was a hindrance from the directors. They were putting challenges. But over here, it seems that these two people are willing. They are willing to sell it. They are willing to have a table talk and then discuss the bid. Are we all clear over the scenario? I hope you did like my energy and I am expecting same energy from all of you, correct? So this is the question that we went through. To summarize, there is a company, Garnet company, which is your acquirer. Then there are two possible target companies, Pilser company and Meriu company. Pilser company directors are putting challenges, but when we talk about Meriu company directors or the senior management and the owners and the shareholders, they are more welcoming. Now, if we read the requirements required, A, analyze the suitability of Pilser company and Meriu company as possible takeover targets for Garnet company. Note, no calculations are required for part A, 6 marks. I believe that this is an easy question. Now, you must be thinking that at home when you were doing theory questions, you were scratching your head. You were unable to find answers to theory. But over here, things are so simple. You have to You have to answer it for 6 marks, which means 6 valid points. 3 for Pilser, 3 for Meru. You can talk about the cultural differences between Pilser and Garnet. You can talk about the welcoming gesture from the two owners. You can talk about the structure of shared distribution. In Pilser, it is a listed company. But in case of Meru, there are two people only. Do you think this life club class is proving a source of, like, a good source for you? Do you think that by reading the question like this, a yelling, shouting, and discussing and being interactively participating, you are able to do the theory yourself? I don't think there will be anyone who will score 1 or 2 marks now. They will easily get at least 3, 4, or 5, and you just need 3 marks. Can't you write 3 proper points? Obviously, you can. So, what you have to do at home is that you have to keep shouting in your room. Okay? Keep shouting and let everyone know what you are reading and tell them. Call them to your room and tell them you will shout at them and read the question. Okay? So, this is how we read the question, and I am sure that you will be able to write down some points. Let's see what the ACC answer was all about. Let's see what the ACC answer was all about, and look at the ACC answer first. And then I have pointed out some key points as well. Okay. Keep shouting, keep yelling. If you are alone at home, you deserve a loud yell. Okay. All right. Answer A, strategic fit and income streams. Obviously, when you are acquiring some other company, you see that is the other company strategically fit, the cultures and all everything are aligned or not, then will the other company be a good source of income for you? So ACC answer has two different points that are mentioned over here. Let's read these points together. When we talk about a strategic fit, it says the most important reason for acquiring either company is a strategic fit, whether they will enhance what Garnet company currently offers or offers opportunities for further development. Although Pilser company appears to operate in a complementary area to Garnet company, in some way it does not appear attractive. It may be easier for Garnet to develop law and tax compliance course itself with its existing resources and recruiting extra staff required individually rather than going through the formalities and likely conflicts in acquiring Pilser. A company which has not been very successful, Pilser is not very successful. The main area in which Garnet Company could develop Pilser Company business is e-learning. Here, Garnet Company's success in developing e-learning in its area could complement Pilser. Okay. So, what is the strategic fit? Actually, it is saying that there are some challenges, some difficulties. We can ourselves appoint some additional resources and develop the tax and the compliance courses that Pilser Company is doing. We already have all the digital and the e-learning platforms and everything. Meru Company offers wider opportunity to provide professional development courses to Garnet Company's existing clients. They had a wide variety, correct? They were also spread in the health and the risk and all the different courses. It also offers a new client base for Garnet Company to sell its own courses. Much of Meru Company's business is personal skill training, where it may be more difficult to develop e-learning packages. However, there may be scope to develop in areas where lots of people have to be trained, for example, health and safety courses. Meru Company has also been more successful at developing its business recently, and it is quite possible that its team is more motivated. What do we mean by more successful? We read that Meru Company has more profits. So when you have more profits, you are considered more successful. When you are more successful or your company is more successful, your staff is more, you can say, motivated. Okay. The staff is more motivated. Correct. Increasing profits and revenue. Income stream, Garnet Company's directors must also consider the risk attached to the income stream offered by the two targets. Pilser Company's revenues have not been growing quickly. We discussed this point. But the company operates in areas where training will always be needed, either to obtain qualification or to provide professional updates in areas where regulations change regularly. Meru Company's revenue stream is a smaller. It is a smaller company. It is an unlisted company. The company is less well established and it operates in areas which could grow significantly, but which may be vulnerable if the organization which Mehru company serves decides to cut back on their training. Now, one important thing they have highlighted is that although Pilsner company is struggling in terms of revenue, but their courses are for tax, for law, they keep on changing, they keep on updating. And when we talk about Mehru company, you need some contractors, maybe another company hiring you for their health and safety trainings, correct? Then there is a shareholder impact, then a post-acquisition impact. I believe you can go over these points once. Also, I prepared a summary. Did you guys check the summary document? I sent you guys a summary document before we started with the class. Did you guys check the summary document? Let me open that summary document for you on the screens. We have prepared a summary document for this particular question so that we can remember and retain the bullet points. It is uploaded on the Google Drive as well. And I am going to put it over here in a moment as well. So here you go. I have prepared a summary document so it is easier for you. It is easier for you to memorize and to repeat and to learn some key points. I've sent this file on the WhatsApp group as well. It is available on your Google Drive as well. I have talked about a strategic fit and wrote some bullet points. But do remember, in exam, you are going to write short paragraphs, okay? Let's read about shareholders. All Garant company needs to do to obtain a controlling interest in Mehru company is to buy the shares of two shareholders, Richard and Katie. We discussed this, correct? That if Garant company wants to acquire Mehru company, there are only 2% they are going to deal with. As Pilsner company is listed company, it is likely to have a larger number of shareholders. It may be more difficult and time consuming to convince enough shareholders to sell their shares, correct? Post-acquisition operations, if it acquires either company, Garant company faces the choice of whether to allow it to operate as a quasi-independent entity or completely absorbing it. Garant company's directors will also need to consider the compatibility of its culture with two targets. Now, in your exam, you have to write 6 valid points. I believe the easiest points were number one, this. You discuss the shareholding structure. You tell the examiner that in case of Mehru company, there are only 2 people that you have to deal with. But in case of Pilsner company, there are more than 2 people. If you write this point in detail in around like maybe 4 to 5 sentences, you get 2 to 3 marks. Okay, you get 2 marks. Then for post-acquisition operations, if you write these 2 lines, you get 2 to 3 marks. ACCA answers are very detailed. Even these bullet points are very detailed. You are not expected to write 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10 things. You have to focus on lesser things and write more. ACCA answer covers all the angles. Let's read the marking scheme of this particular question to make you understand more better. I believe, yes, we have the marking scheme. Read this carefully, how the examiner is going to give you marks. Read this carefully. For the theory answer, the examiner said, a wide range of points is possible, but give credit for discussion of a strategic fit, future income stream, shareholders, and what will happen post-acquisition. Issues relating to Pilsner company, 3 to 4 marks. Issues relating to Mehru company, 3 to 4 marks. So why 3 to 4 marks? Is it an 8 marks question? Why is the examiner mentioning that they will give you 3 to 4 marks? This means that if someone writes Pilsner company very well, they are going to give you more than 3 marks as well, but the maximum limit is 4 marks. I repeat my point. When the examiner is stating that if you write about Pilsner company, you will get 3 to 4 marks, and if you write about Mehru company, you will get 3 to 4 marks, but the total question is of 6 marks. This means that if someone writes more about Pilsner company, they can get more than 3 marks, but the maximum marks that they will get is 4. Then in case of Mehru company, if you write some points, they will get maximum 2. So now listen to me carefully. In your exam, these small questions are marks gaining. I expect you to write more. Okay? Like if you think that you need 3 points, write 4 points. If you think you have wrote 2 points about Pilsner, write 3 points about Pilsner and 3 points for Mehru. So if something is wrong, the other will compensate it. Are you all clear? So this means that there were 8 marks, out of which you will be marked out of 6 and you need just 3. So effectively you need 3 marks out of 8. It is not out of 6. It is out of 8 you need 3 marks. But your marking, your original marking or your final marking will be out of 6. Are we all clear? So this is how your theory answers are going to be answered. And I'm going to share this document once again to everyone. I have already shared this document, but I am going to share it again. You are not expected to write this lengthy answer. Even if you write 50%, that is fair enough. Let's move to the question again and let's continue our discussion. Okay, we have one question. It is not like the points will be marked in. No, it is not like this. If you are writing like 10 points and if first 3 are wrong, they will check the rest 7. Okay. If you are right, if you, for example, write 8 points, if you write 8 points and in sequence first 3 are wrong, this does not mean that they are going to 0, 0, 0 and give you 0. They will check the rest 5 points. So if you write 8 points and any 6 in any sequence, any 6 points are correct, you are going to get full marks. Okay. Now, moving to the next question, it says calculate. No penalty. I remember I had 6 national positions in ACCA and CA, so I used to write a lot. Even even at the end of the paper, we used to have the handwritten exams. We never had CB exams. So I used to leave paragraphs or gaps in between my answers, and then whenever I was done with the paper, I kept filling with irrelevant or relevant point anything. Okay. So keep writing. There is no penalty for wrong answers. Okay. All right. Calculate the minimum price which Wilson Company shareholders are expected to accept. Minimum price which Wilson Company shareholders are expected to accept. Do you guys remember? What did these shareholders tell you? How much premium do they need? Percentage of premium. 14%, correct? Agreed? They need 14% premium. Okay. What is the second part? It says the target price which guaranteed companies will pay based on a free cash flows to equity valuation on the basis of 60% of the gains from the acquisition accruing to its shareholders. The target price means what will you pay based on the free cash flows to equity valuation model. If you need 60% gain, and gain of what? Gain of the synergy. The percentage of gains from the acquisition which will accrue to Garnet Company shareholders if Garnet Company paid the minimum price which Pilser Company shareholders are expected to accept based on a free cash flows to equity model. Now, what does this mean? Percentage of gain. For example, if total synergy, let's assume total synergy is 200, and we know that Pilser Company is taking advantage of, let's say, 50 synergy, and the rest of the synergy is belonging to Garnet Company, which is 200 minus 50, which is 150. They enjoy how much percentage of total synergistic benefit? 75%, and Pilser is enjoying 50 divided by 200, which is 25%. So you have to calculate a percentage. Gain or the percentage of synergistic benefits that Garnet Company shareholders will enjoy, provided the buying price is at the minimum acceptable price for Pilser Company shareholders. Are we all clear till now? Okay, are we all clear? This is all computational area. We are going to discuss it. But right now, let's hold this computational area and move to the third part, which is C, which says discuss the feasibility and effectiveness of the defense strategies suggested to fight a takeover bid for Pilser Company. There were 2 defense strategies, correct? There were 2 defense strategies. First, find a bidder, find a friendly bidder. And second, what were the 2 strategies? Find a friendly bidder. And the second one was to make a counter offer. Find a bidder means find someone else to acquire you who is your friend. And the second one is Pac-Man, which means you tell them that you want to buy them. Okay. So you have to discuss these two strategies. Let's move to the strategies and let's see. These are the two detailed answers. First, let's see the marking. How is ACCA going to mark your answer or the script? Let's see what they are saying about marking. So again, the maximum marks are 5. Maximum marks are 5. Okay. And friendly bidder defense. If you get discuss friendly bidder defense, you are going to get 3 marks maximum. In case of counter bid defense, if you get 3 marks in the first, you will get 2 marks maximum. Okay. Okay, Kamran, we will come back to the synergy point in a while when we are doing calculations. Do understand the marking. So again, you have to write your answer for 6 marks, a reasonable length answer for both. Also do note that ACCA answers are in short paragraphs, okay? Are in paragraphs. You have to write paragraphs like these. Like this is the first point or the first theme. If you check the paragraph size, it is 2 to 3 sentences paragraph, and then they change the paragraph, and then they change the paragraph again, and they do it again, and they do it again. So now, friendly bidder, let's see. The board of Pilsner company fears the loss of independence and changes which acquisitions by garment company may bring, and in particular the threat to their own jobs. This is the problem why they were finding someone. Under best corporate governance practice, they must act in accordance with the best interest of Pilsner company shareholders rather than own self-interest. Attempting to find another buyer to bid may be viewed as legitimate if the bid is higher. For example, if the board of directors are able to find someone who is paying a greater price, that's where shareholders will also agree. Shareholders will also agree if the other bidder or the other company is your friend and the friend is paying more. They are paying extra. They are paying more to you. They are paying more to you. Absolutely perfect. Correct? Moving on, it says, however, Pilsner company operates in a specialist area and is listed on the smaller company investment market rather than the main market. It is not a very huge company, perhaps making it less appealing as an investment. It is quite possible that a friendly bidder may not be found. It is difficult to find a friendly bidder. Why? Because your company is not a listed company. It is not a very popular company. It is not a very huge company. If Pilsner Company's directors fail to find one, this may persuade its shareholders to accept a lower price from Garnet Company. Also, given Pilsner Company's lack of recent growth, the acquirer may feel it has to make significant changes to improve the businesses, even if it says when it bids that it does not plan major changes. Are we clear on this? So it is fairly very simple, very simple thing that is being discussed over here. And the thing is that your company is not a listed company. It is not very attractive. You were also making some losses. It might be difficult to find a friendly bidder and to protect your jobs maybe. So these are the valid reasons. These are the reasons that are justifying and explaining. Actually, what was your requirement? Your requirement was to what? Your requirement was to discuss. Yes, discuss the feasibility and effectiveness. So is it feasible? Is it effective? I don't think so. Then we come to the counter bid. Then we come to the counter bid, which is the second thing. And again, in the 67 pages booklet, you will find everything that you need about this. Okay. So what is it saying in the counter bid thing? If directors are acting in the best interest of Pilsner company, any bid for garment company should have a strategic logic to it. There are strategic reasons in favor of Pilsner company bidding for garnet. Are there any strategic reasons? Are there any strategic reasons why will I place a bid for garment company, someone who has come to acquire me? Diversification into areas of training which has shown better growth than Pilsner company's current main areas, and also acquiring garment company's e-learning capabilities. I can justify people that I am going to diversify in these areas. Agreed? And that's why I want to acquire garment company. The directors of Pilsner company will remain in charge of the business. However, if Pilsner company has not been planning an acquisition, it is doubtful whether it is the strategic plan necessary to make the merger work. It may also face resistance from garment company's staff who see themselves as being taken over by a less successful company with a weaker culture. Okay. So these are some theoretical points that you were supposed to write in this question. Are we all clear on this? And once we are clear on this, we can move to the computation part. Correct? We can move to the computation part. Are we all clear? Any issues? Please let me know so that we can move forward. Correct? Agreed? I hope everyone is as energetic as me. Okay? Let's move on and let's go to the computational area. Now, again, as I have to discuss multiple questions, I will try to save the time. And in order to save time, I am going to share the workings with you. And yes, I am going to explain everything. And this sheet has been shared with all of you as well. Can you see this sheet with you? I hope you all know, you all have this sheet with you. I have sent you all this specific sheet on the WhatsApp as well. So I am hopeful that you all have this sheet. Is it okay? Do you guys have this sheet with you? Okay. All right. Now, step number one, in the first step, I just simply wrote all the data as per the question. What was the data of the question? Number of shares, share price, free cash flows to equity, beta equity and beta asset of Pilser were given. Pilser is the target company. Then growth rate of free cash flows to equity is also provided. If you check, you will find the growth rate of free cash flows to equity. It was already mentioned, given. And the free cash flows to equity multiple was given for Grandin company. Okay. Now for Garnet company, how will you find market value of equity? What are the two things that you are going to multiply? What are the two things in case of Garnet company that you are going to multiply to find the market value of Garnet company? When you are given with the free cash flows to equity multiple, when you are given with the free cash flows to equity multiple, what will you do? You will multiply the free cash flows to equity multiple with the free cash flows to equity. But in case of Pilser company, you need to discount all the future cash flows and bring them today. Correct? Okay. Then there was some general data, risk-free rate was given to you, market risk premium was given to you. Now, post-acquisition, free cash flow synergies, annual synergy value was given to you as 9. Agreed? Do you all agree? Post-acquisition, free cash flow synergy value was given to you, which was 9. Then free cash flow to equity multiple will increase by 5%. This was given to you. Minimum premium expected by the Pilser company shareholder of 14% was given to you. And the Garnet company shareholders will accept a target gain of 60%. This was also given to you. So step number one is everything that is already provided to you in the question. It is already there. You just need to extract. You just need to make sure that you find it. Okay, agreed? All good till now? Okay. Moving on, step number 2, I found the pre-acquisition values of each company. Now for Garnet company, it was simple, which is your free cash flows to equity multiplied by the multiplier. So your free cash flows to equity is 60 and your multiplier is 8. If you multiply your free cash flows to equity with this particular multiple, you can find the market value of Garnet company. And you all have this Excel file. If you don't have the Excel file, if you are someone who has just joined us, or if you're someone who is not an enrolled student and need these Excel files and other documents, you can simply WhatsApp me right after the session. Then for Pilser company, we calculated cost of equity, which is 15%. Cost of equity is 3.8% plus 1.5 into 8%. Okay, wasn't this multiple post-acquisition? No, Mehvesh. There are two multiples. Listen carefully. Free cash flows multiple of 8 was given pre-acquisition. Free cash flows to equity multiple of 8 was given as pre-acquisition. For post-acquisition, the question stated that if the acquisition goes ahead, this multiple is going to increase by 5%. The post-acquisition multiple was 8.4. Mehvesh, we did work this out. 8 multiplied by 1 plus 5%. For the post-acquisition case, it was supposed to increase by 5% and it can become 8.4. Agreed? Okay. Now, how do we value Pilser company? The formula is very simple. Free cash flows to equity multiplied by 1 plus growth rate divided by cost of equity minus growth rate. This is a very, very common formula that is used several times in your past paper questions. Do you all agree? Do you all agree? Kindly confirm, do you all agree with this? It is a very simple formula that we use again and again and again and again, and we use it several times. And the formula is free cash flows to uh, your free cash flows to equity, which is cell Q8. Let me show you cell Q8. You already have the sheet with you. But if you check the cell Q8, free cash flows to equity is 70 multiplied by 1 plus growth rate, 1 plus growth rate of free cash flows to equity. So growth rate of free cash flows to equity of 1.5% was given to you already. Agreed? Divided by cost of equity minus growth rate. Cost of equity you found out using capital asset pricing model minus the growth rate, which is 1.5%. You can easily work out the valuation of Pilser company based on free cash flows to equity model. This valuation is based on free cash flows to equity model. It may differ with the market value of the company on the stock exchange or the value of shares. As discussed, there are multiple models. Agreed? Are we all clear? Okay. So over here, what we used is the free cash flows to equity model to value entire company, because this was the recommended and stated method in the question. Okay. Moving on. What's next? Let's find out the post acquisition value. So post acquisition multiple was 5% more. So 8, which is your pre acquisition multiple multiplied by 1.05, which will give you 8.4. And what will be your free cash flows to equity post acquisition will be 60, 70, and 9. 60 for Garnet company, 70 for Pilser company, and 9, which are your free cash flow synergistic benefits. Again, I emphasize that your synergies can be given in two different ways. Agreed? Agreed? Your synergies can be given in terms of number one, market value. Number two, in terms of cash flows. Over here, your synergy was given as a cash flow, which means that your overall cash flows, the free cash flows equity of 60 and 70 are going to increase by 9. The free cash flows equity of 60 and 70 are going to increase by 9. So 60, 70, 9. 60, 70, 9 will give you what? 60 plus 70 plus 9. Will this give you the market value of the new company? 60 plus 70 plus 9. Will this give you the market value of the new company? Yes or no? Is it going to give you the market value of the new company? Is it going to give you the market value of the? No, it is not going to give you market value. It is going to give you the total free cash flows to equity of the new company. It will give you the total free cash flows to equity of the new company. 60 is acquirers free cash flows, 70 are the targets free cash flows. These are total 130 plus 9 free cash flows of synergy. So this means, sir, what if, okay, we will discuss that as well right now. This 139 represents the total free cash flows, the total annual free cash flows after acquisition of the new company. In order to find out the market value, you will multiply it with the multiplier factor. Sir, why multiplier factor and why not discounting using the KE? Because the KE was for Pilser company only, for your acquirer, for the boss, for the parent, for the main company. The valuation is being calculated using the multiplier impact or the multiplier factor. Do you all agree? Clear on this one? All good? Okay. Now there is one question, sir. What if synergy was given in terms of market value? Okay, 8.4. Let me show you 8.4. It stated, the question stated that your multiplier will increase by 5%. Your multiplier will increase by 5% if the acquisition goes ahead. Your multiplier will increase by 5% if the acquisition goes ahead, which means that 8, the previous multiplier multiplied by 1.05. Okay, what if the synergy was given in terms of market value? For example, what if the question stated that if both the companies merge, there will be an increase of 20 in the market value? Can someone tell me what will we do in that case? For example, if the question is stated that your overall market value will increase by 20, or the fee or the synergistic impact is that there will be an increase in market value of 20. In that case, we will not include it over here. Number one, change number one, we will not include the 20 value over here. We will first multiply 130 by 8.4. We will first multiply sum of these two. We will first multiply 130 by 8.4 and then separately add that 20 value. Are you all able to understand me what I am saying? Guys, I need participation in the chat box. Understood? Okay. No, sir. Okay, you did not understand. Listen carefully once again. Listen carefully once again. Is this clear? Is the current scenario clear? First, let me clear the current scenario. Those students who are facing difficulty in this current scenario, I believe this current scenario is very simple. Free cash flows to equity multiplied by the multiplier. Agreed? Agreed? This is the case which is clear, correct? Now I said, what if in the question it is stated that synergy is in terms of market value and it is 20. In this case, this is not a free cash flow. They are saying that when both the companies merge, your total market value will itself increase by 20 due to synergy. Okay, for example, if this line is stated and this synergy is not given, the synergy of 9 is not given. Synergy is not given like this. For example, the synergy is not given like free cash flow synergy of 9, but the synergy is given in terms of market value. When we talk about market value and cash flows, both are different. Market value is actually the final value. So they are saying that your final value will increase by 20 due to synergy. In this particular case, what you will do is that you will add this 60 and add this 70. These are the free cash flows to equity of the new company. Okay, free cash flows to equity of the new company will be 130. It will not be 139. It will be 130. Then to value the entire new company value, what you will do is that you will multiply this 130 by 8.9, which is the multiplier, and add 20 separately. Add 20 separately. You can think of it as it is already a multiplied amount. Are we now clear? Those students who are still unclear, let me know. Mevesh, are you clear? There are certain students who felt that this is confusing. Oh, sorry, 8.4. Clear? If the synergy is given in terms of market value, you will calculate the market value of the 130 separately and then add on 20 separately. Are we all clear on this? But in this question, this was not the case. Your synergies were given in terms of market value. Your synergy was given in terms of market value already. So it is an easier case. Okay. Are we all clear? All right. Moving ahead. But again, let me know how many of you are not regular students, because if you are not a regular student, I need to add you to the WhatsApp group right after the session ends. So you have to let me know. Okay. All right. Moving ahead. Shall we move on? All good till now? I hope I am able to maintain the same energy till the end of the session so that we are able to discuss maximum thing. Those who are not enrolled, those who are attending the session but they are not enrolled students, make sure that you WhatsApp me right after the session ends. Those students who are not enrolled, make sure that you WhatsApp me right after the session ends. Okay. Okay, let me mention my number as well, but I believe there is some problem in opening the sheet. Okay, let me open it anyways. All right. So, okay, let me put my number, but I need a minute. To do it. Okay. All right. Let me put my number over here once again. My WhatsApp number. WhatsApp number after the session, which you can use to contact me. Those who are not enrolled, if they want to get added into the WhatsApp group and need secret sauce and all the documents, what they can do is they can message me on 00971 58560 8907. Okay, 00971 585068907. Or in fact, you can start sending me a WhatsApp so that I can also save your number. Okay, everyone. Now we are clear till here, correct? We are clear till the market value of the company. We are clear to this point, correct? Agreed? Now this is the value creation. How do we calculate the value creation? Value creation is actually the difference of the value of the new company and the value of the previous companies. Agreed? So 1167.6 is the value, is the market value post acquisition of the new company less the value of Garnet company and Pilser company. So 1167.6, the total market value of the combined company minus the pre-acquisition values of the individual independent companies will give you how much value has been actually created. Are we clear on this point? This is the value creation. This is the synergy. This is the total amount of synergistic benefits that are going to be achieved if we go for this Pilser company acquisition. Moving ahead. What were the requirements? Number one, the minimum price. Okay, till now we did some general working, correct? Now, what is the first requirement? The minimum price which Pilser company shareholders are expected to accept. And how much premium they want? How much premium they want? They want a premium of 14%. Excellent. So now we are doing our first requirement, which is, the current market value of shares. Current market value of shares is simply number of shares, which are 100 multiplied by 5.4. So the current market value of the shares is 540, which is number of shares multiplied by the market price per share. This gives you the market value of all the shares. They want 14% premium. So over the current price, they need 14% extra, which means 540 plus the 14% of 540. So total acceptable price for all shares is 615.6. Now do remember, the valuation technique of free cash flows is the technique that you use to value that particular company or to find what the value is about. But if they are saying that they want a premium, obviously they want a premium over the market price. That is the agreed universally acceptable price between everyone. So they said that our shares on the stock exchange have a net worth or a total worth of 540, which is 100 into 5.4. We need 14% above this amount, which is 75.6. So we can sell all our shares in 615.6. And since it is a value of 100 shares, so per share value can be calculated as total value divided by number of shares. Are we all clear there in this first part? Please let me know. Guys, I need participation. I need participation from all of you and same energy from your side as I'm giving over here. Okay. So this is the acceptable price. They are saying that if you give us 6.156 per share, we are going to sell our company. Agreed? Okay. Moving on. Target price Garnet company will pay a free cash flow to equity valuation model. This was your second part. If you need 60% of overall gain, target price Garnet company will pay. What will be the target price that you will pay? What is the amount that you are going to pay? Now you have to find the amount that you are going to pay. Target price Garnet company will pay if 60% of gain accrues to its shareholders based on free cash flow to equity model. Okay, valuation of target company pre-acquisition. This is the valuation of the target company pre-acquisition 526.2963. Agreed? The value of Pilser company. What is the target company? Target company is the company that you are acquiring. So we value this target company as 526.2963 based on free cash flows to equity model. Now we are coming to free cash flows to equity model. The question said that you have to use the free cash flows to equity model when you are paying them price, when you are valuing them. Okay. Then, if Garnet company thinks that they want 60% of gain for themselves, if Garnet company thinks that they want 60% of gain for themselves, how much gain are they willing to pay to the other party? 40%, correct? For example, if you know that the total benefit is 100 and if you want 60, you are willing to give away 40. So we know that this is the pre-acquisition value. Then the benefit was 161.3037. The total benefit was 161.3037. You are willing to give away 40% to them. You are willing to give away 40% to them. So if you are willing to give away 40% of the benefit that will arise, you are actually giving them a target price or a total price of 590.8178. Now this 590.8178 means the value of their company based on free cash flows to equity model plus a 40% pop-up or a 40% extra or the 40% of the value that is created or 40% of the synergistic benefits going to them. So you are asking them to sell their company at 5.908 per share. This is calculated as the total value, the total target price that you are willing to give divided by the number of shares that you are buying. So you are telling them to sell their company at 5.908 per share because your shareholders have probably asked you that we will need or we want or we will go for the acquisition if we get a 60% gain for ourselves. Agreed with this value? Are you all enjoying the live session? Is it effective? Is it beneficial? Are you all awake? All good? Okay. Keep me motivated and keep typing something in the chat box. It lets me be on the track. Okay. So actually what is happening is that, let me repeat, the company is valued at 526.2963 based on free cash flow to equity model. You are giving them 40% of the gain or the synergistic benefits. So the total amount you are paying them is 590.8178. When you pay them 590.8178, it is at a 40% extra amount. Okay. All right. So the per share value is the total value divided by number of shares. No, Pilser was looking for how much? Pilser was looking for 14% gain over their current share value. Pilser company shareholders are willing to sell it at 6.156 per share. Pilser company's current market price, which is number of shares into the market price per share, is 540. They want a 14% gain. So they are asking for 615.6. 615.6 for the entire company or 6.156 for each share. Okay. Pilser company is asking this much, but you are willing to give this much because you think that 60% of synergistic benefits must come to you. Yes, we can say there is a conflict. There might be negotiations or something because they are asking a 14% premium over the current market price, which is 6.156, and you are willing to pay 5.908. Okay. Yes, this point is also stated in the question that currently the shares of Pilser company seem to be overstated in the market, and over that they are also asking 14% extra because based on free cash flows to equity model, the true value of their shares come out to be 5.26, not even 5.9. 5.9 is after adding or giving them some synergistic benefits. Without synergistic benefit, free cash flows to equity model suggests that their company's worth is 526.2963. All right, so this was the second part. Then moving to the third part, percentage of gain to Garnet company shareholders if minimum price paid to Pilser company. Okay. Now, what if Garnet company agrees, okay, fair enough, we are going to acquire Pilser company at 6.156 because they are not agreeing below this, correct? They are not agreeing below this. Agreed? Pilser company is saying that we need 6.156 per share at least, otherwise we are not selling our company. So the next question is, what if we agree? What if we agree to them? What if we sell the company to them? How much percentage gain will we get? Now, listen carefully. There are two methods. Method number one, this is the total value of the new company. Correct? 1167.60. How? Let me show you over here. 1167.6. Correct? This is the market value of the combined company. This is the market value of the new company. This is the total market value of this new company. Agreed? This includes Pelser company shareholders, Garnet company shareholders, everything. Second thing, amount attributable to target company. Now, if they are saying that we will not sell below 615.6, this means that they want 615.6 at minimum. So out of the total value of 1167.6, 615.6 will belong to them. The rest will be attributable to the shareholders of the acquirer. Agreed? Total minus attributable to the target gives you the amount left over with the current shareholders. Now, this means that in the new company, the previous shareholders of Garnet will have shares of 552. Their pre-acquisition value was 480. Before acquisition, their valuation was 480. Correct? We calculated this as well. 480. So, actually, they are gaining 552 less 480, which is 44.64% of the total gain. 72 gain attributable to Garnet company shareholders divided by the total gain of 161.3037. So if we agree to their terms, we will get 44.64% of the total gain. Our value is increasing by 72. The total company's values, both company values are increasing by 161.30. So it is 44% something of the total value. Are we all together? You all have these sheets. I will give you 10 minutes break or a 5 minutes break to review all the files, all the sheets as well. And then we will move to the next question. But before that, let me know if there is any significant confusion. I hope there is no significant confusion. All clear? Okay. Shall we move on? Shall we proceed? All good? Okay, let me repeat 615.6. 615.6 is simply the value that they agreed to sell their company at. This is the value that they agreed. Correct? No, Khalid, please, not right now. Yes, you can chat with me during break, but not right now. Okay? Okay, I am going to share this file with you during the break. In fact, you all have this file, correct? You will review it properly and then come back with queries. Okay, then there is method number two. I did two methods in your ACC answer. There were two methods as well. You can look into the other method as well. In the other method, what I have done is that this is the target company's shareholders post-acquisition value. We compare it with the pre-acquisition value. So we get how much gain they are getting. Total gain minus the gain that they are getting will again give us the same value. Okay. All right. Now what we are doing is that we are going to take a 10 minutes break. Okay, it is going to be a 10 minutes break so that you all can actually reconcile yourself, look into these files. Okay, so it is 9:20 over here, 9:26 over here. We discussed the first question, which was in fact June 2024 past paper question number 3. After break, we are going to come to the second question, but during the break, you all will actually revisit the Excel file of the solution and read the theory answer as well. All right. Okay, so it is 9:27. Your break is for, let's say, how about 20 minutes? Because you all need to review the file as well, correct? Let me give you 20 minutes break. We will come back at 9:47 Park Standard Time. Okay, take 20 minutes, reread the Excel file and the PDF file. Those who are not enrolled students, WhatsApp me so that I add you to the group. My WhatsApp number, actually I forget my number again and again. It is 00971 58506890 or plus 971 5850 68907. Also, I need feedback of the class till now. We just did June 2024 question number 3, both theory plus the workings. We are going for a 20 minutes break. In fact, let's take it to 25 minutes so that you all can review the file properly. Once we are back, we are going to discuss some problems if there are any and move on. Thank you. And let's meet after the break. All right. Hello all. Is my voice audible? All good? Okay. So now tell me, is there any confusion in this first question that we did, which is question number 3? Or are we clear on it? No confusions? Anyone with any sort of confusion? I hope that during the break, you all reviewed it properly. Correct? So we can proceed. Was it an easy question to handle? Okay. Was it easy? Okay. All right. So this was one of the questions from June 2024. Okay. June 2024. Okay, Khalid. Ask me, what do you want to ask? A little complication. Okay. If there is anything that you need to ask from the previous confusion, it is step 3 from 60% onwards. Okay. Let me discuss the confusions that you have. Okay, tell me, what is your confusion? Your confusion, is this clear? Let me highlight. Is this clear? Is this area clear? Any confusions in this part? Any confusion in this part? Okay, 40% gain given to shareholder. Do you mean that you have confusion over here? Is that what you want to ask? You have confusion in cell Q51? Okay. Now, actually, what is happening is Garnet company shareholders want 60% of gain themselves. Correct? So if they want 60% gain themselves, how much are they willing to give away? If total is 100% and they want 60%, they are willing to give away 40%. So you take 40% of the total synergy. This is the total synergy value, and they are willing to give away 40% to the target company, correct? Yes. This 40% will be given to Pilser company's shareholders. They are willing, they have agreed, or they have no problem in giving away 40% gain. Okay. This is the pre-acquisition value of target company based on free cash flows to equity model, correct? Now, when we talk about pre-acquisition value, it is without the benefits of synergy incorporated. But when both the companies will merge together, there will be synergistic benefits as well, correct? So the new value, they are going to be paid the previous value plus 40% of benefit. So this is the price I am paying to them, correct? This is the pre-acquisition value. Synergy is separate from it. So the total that I am paying them is 590. 40% of the synergistic benefit and their original value based on free cash flows model. Okay, now it is correct. Anyone else with any sort of confusion in this question, please ask me. Okay, I am giving 1 more minute, and after which we will move to the new question. Sir, it is the total price that to be paid. Yes, it is. Yes, correct. It is the total price. Okay. This 590.8178 is the total consideration that I am willing to pay. Okay. All good now? Everyone? Okay. Shivoy, you have problem in value creation? Can you please tell me, Shivoy, do you want me to explain this Q38? Okay. 1167.6 is the value of the new company, the value at which new company will stand at, correct? And we are subtracting the pre-acquisition values. So post minus pre-values give you the difference that has been created due to synergy, correct? 480 and 526.29 are the previous values. The new value is 1167.6. So actually the value has increased by some amount. Agreed? All good? Okay, now everyone is added to the WhatsApp group, the public group, and everyone has the sheets and everything. Anyone who has just joined us and who is not a regular student as well, if there is someone, do let me know. Okay, so we are done with this first question. I will now not discuss it live. You will be given this sheet. I have given ample time to everyone. All right. Okay, so closing this sheet now. Now let's move to question number 2 of the paper. Okay, let's move to question number 2. Once again, let's begin. And are you all ready for it? Are you all ready for the question? Okay, let's start. So now we are going to discuss June 2024 question number 2. Okay, June 2024 question number 2 is about investment appraisal and BSOP model and some theory. The question says, Little Brady Company is a supplier of furniture and equipment. Little Brady Company is listed on its local stock exchange and is subject to a principle-based corporate governance code. Principle-based corporate governance code means there are some principles that you have to follow while reporting and disclosing your information. Little Brady Company's board is currently considering 2 major investment projects. So now this is taking us towards investment appraisal. And there are two types of projects that we have to consider. One is an investment in facilities to manufacture office pods. I hope you all understand what is office pods, correct? The other is an investment in facilities to manufacture furniture and equipment for schools and universities. So these are the two different types of projects that are under consideration. Are we all together? Okay. One is for office pods and the other is for the furniture and equipment of the schools and universities. Two different things are being considered. The investment required for the manufacture of office pods can be assumed to happen very soon, and production for a full year will start almost immediately, which means that the investment will be at year number zero. Year number zero or today. Sales revenue and contribution figures over the investment's 4-year life are forecast to be as follows. You are given with the sales revenue values and contribution values. Fixed costs are expected to be 8 million in year 1, rising by 5% each year in years 2 to 4. So fixed cost in year 1 will be 8. Then you multiply it by 1.05. You multiply again by 1.05. You multiply that again by 1.05. Agreed? Now, the initial investment in non-current assets is expected to be 60 million. This is the outflow at year 0. A tax allowance of 100% is available immediately on this investment. Now, this tax clause is different and unique in every question. You have to be very, very careful while reading the tax matter. Over here, it states that the tax allowable depreciation is 100% allowed in the first year. That is immediately, which means in this question, not in every question, in this question, if you are investing 60 million, your first year's tax allowable depreciation will be 60 million as well. Okay? Try to understand that the tax treatment in every question is going to be different. Generally, they provide a particular percentage, like 20% every year, 10% every year, based on reducing balance method, based on a straight line method. But over here, they are saying that if you have invested certain amount, we are going to allow 100% amount as tax allowable depreciation in the first year. The tax authorities are saying that if you have invested 60 million, you can reduce your taxable income of first year by entire 60 million in the very first year. So there is not going to be depreciation spread over 4 years. It is not like 60 divided by 4, 15, 15, 15, 15. It is 60, 100% in the first year. The tax authorities are saying that we will allow 100% as a tax deductible expense in the very, very first year. Okay. The year 4 realizable value of the investment can be assumed to be 5 million and this amount will be tax deductible. Now, try to understand cost is 60 and entire 60 is allowed as tax depreciation. So your net book value is standing at 0, correct? From the first year, your net book value is standing at 0. So if you are selling something at 5 million at the end of 5th year, the tax authorities are saying we are going to tax that entire amount. So this is your cash flow as well as gain or profit on disposal, which is taxable. Are we all together? Now, this is a new and a unique treatment in every question in AFM. Practice is the key to pass the exam. All your exam papers have a unique way of asking tax allowable depreciation and tax treatment. No, we will pay tax in the year of disposal. We will pay tax in year of disposal. Okay. So there are two new things over here. Number one, entire receipts, all the sales proceeds are taxable in the last year when you sell the asset because your net book value is 0. So entire amount is taxable. Number two, entire depreciation can be charged in year number 1. Now, there are X or y number of permutation and combinations of text treatment. You cannot learn them, but in the exam, you have to use your brain to 200%, your common sense, and judge what the question is saying. All questions will have a different text treatment. Okay, so this is a unique treatment in this question. Working capital at the start of each year is expected to be 10% of the expected sales revenue for that year. Any remaining working capital will be released at the end of the project. Very simple treatment, asked several times. Tax is payable at an annual rate of 20% on profits in the same year in which the profit arises. Tax losses must be carried forward and offset against profits from the same investment. Now, do you guys remember there are two different treatments of tax losses? I shared a Word document which emphasized on the different treatments. Sometimes your question will say that if there are tax losses, carry forward and adjust the future profits of the same investment, like over here. And sometimes they will say that if there are tax losses, you can utilize those tax losses to reduce your taxable income of some other project. In that case, there is a different treatment. So you have to be very, very careful. Over here, the treatment is that if there are tax losses, you carry it forward and you offset the future profits of this same project, this same investment, and reduce taxable profits of the coming years and then pay the tax. So there are two different unique treatments. Please be with me. There is a Word document that I have shared with you, which you need to focus. Okay, are we clear? All right. Moving forward, I will reshare the document as well. Okay, moving forward. Okay. Now, further it says that the applicable cost of capital for this investment appraisal is 11%. Little Brady Company has not previously supplied furniture and equipment to schools and universities. Little Brady Company has not previously supplied furniture and equipment to schools and universities. Okay, Suman, I will open the document right now in the session. On the basis that Little Bed Company is only supplying existing facility, calculation suggests that the proposed investment will have a negative net present value. So you think that the investment will have a negative net present value? There were two ventures. Venture number one was investment of office pods. Above details are about office pod, and now these details are about the furniture and the equipment. So if there is a negative NPV, there is a negative net present value. Do we go with that particular project? Do we go with that particular project or not? Do we actually go with that particular project if there is a negative net present value? Okay. All right. But it says, however, the government has just announced a major program of support for the expansion of schools and universities over the next 10 years. If this expansion goes ahead, Little Brady Company's finance director has forecast that demand for its products will justify $80 million additional expenditure on manufacturing facilities in 4 years' time. The present value, which means today's value of the income from this investment is estimated to be 52.7 million. This means that you are being told that fine, this particular project has a negative net present value, but if you go for this project, the government has announced a major plan and you can go for an expansion later. And if you pay 80 million, you may get certain facilities, certain projects, certain income, and the present value of those incomes is 52.7. How many of you are familiar with the Black-Scholes option pricing model? These are the variables of Black-Scholes option pricing model, correct? BSOP model. And which BSOP model, which option is it? If you have read the 67 pages booklet, you must be familiar that there is a particular type of option that we will have. Okay, call option, but is it option to delay, option to defer, option to expand? What is it? Option to expand. Correct. Excellent. In an option to expand, effectively what happens that you currently go for a project, although it is not beneficial, maybe, for example, net present value is negative, but you know that if you go for this project, in the future, you have chances of expansion. For expansion, you will have to pay 80 million. This is your exercise price. And in return, you will get some future income streams for which the present value is 52.7. This is the present value of the underlying. Okay. It can be assumed that all costs and revenues include inflation. The applicable cost of capital is 11% and the risk-free rate is 3%. The chief executive has estimated the likely volatility of cash flows to be at a standard deviation of 25%. We all know that if we need to use the VSOP model, Black-Scholes option pricing model, we need certain variables. We need risk-free rate. We need a standard deviation. So we are given with that information already. And then we are also given with the cost of capital of 11%. Clear? Okay. Little British company's board feels that the company has been too dependent on demand from the office sector. Hence, it is looking at the investment in the furniture and equipment for the schools and universities, suggesting that they want to diversify. They are operating in one particular segment of furniture, which is office furniture. Now they are thinking that they must diversify. Diversification is always good if you want to spread your risk. Correct? It is also considering the production of furniture for other types of organizations. The board believes the decision it is considering now about investment policy will be important for the future direction of the company. The board does not want to disclose its plan in detail until they are certain for commercial reasons. Now they are planning to diversify into various different segments probably. But on the other hand, they are not willing to disclose their plans anywhere. Okay? Are we all clear? Little British company fulfills the statutory reporting regulation and complies with the requirement of the corporate governance code to produce an annual business review. However, it has faced investor and media criticism that the analysis and commentary on the business which it publishes in its business review is insufficient. Although the company is matching compliance, it is in full compliance of the laws and the regulations, but they are disclosing the minimum possible content that is required. For example, they are not telling anyone that they wish to diversify. And hence, what is happening actually is that what is happening? Actually, what is happening? The thing that is happening is that the people around them reading their annual report are unhappy. Correct? Okay. Little Brady company fulfilled this. Okay, we have read this. Then the main criticism of it have been that it does not disclose clearly the business's future investment strategies and discuss its results in the context of achieving its strategic objectives. Media comments suggest that the lack of clear information about Little Brady company's strategies has been the main reason why its share price has really recently fallen. Okay. Now, you all must be familiar with the integrated reporting concept, correct? And the concept that your annual report must contain more than mere financial information. Obviously, you are not expected to disclose your trade secrets, confidential information, but you need to make your report more crystal clear and having a higher content than normal. Like telling people actually what the company is going to do or what is their vision, their strategy, their objective, their mission. Agreed? So this is why they have wrote everything over here. Now, what is the question A1, evaluate the financial acceptability of the investment in the office plots. A very simple 7 marks question. A very simple 7 marks question dealing with net present value. Okay, net present value. A2, evaluate using the BSOP Black-Scholes option pricing model whether Little Brady Company should proceed with the investment in the furniture and equipment for schools and universities. So in the second case, you have to use the BSOP model, Black-Scholes option pricing model. Are you all aware about the Black-Scholes option pricing model? Have you actually used it? There is a software which will be available for you in the exam. Okay, so this is the second requirement. What is the third requirement? Third requirement is discuss the extent to which the investment in furniture and equipment for the school and universities will represent diversification for Little Brady Company, and then advise Little Brady Company what changes to make to its reporting to provide more information about the rationale for and the factors affecting its future investment strategies. So let's move to the first requirement, which is your financial acceptability. Okay, let's move to the first requirement. All right. Are we all clear? Okay. So when we in exam there 5 variable needs to be put and it will, yes, Soman, you are right. So actually the first part is about financial acceptability. Now let's look into the net present value working, which will tell us if the project is financially viable or not. All right. Just give me a minute. Okay. Now, on the screens, you again have step number 1. So let me explain everything step by step. Okay. Now, this is the main working. Okay, this is the main working. Okay. Let's talk about this main working first. You have contribution. This is as it is given in the question. Okay. Contribution values are given as it is in the question: 24, 42.3, 40.1, and 34.1. So the contribution values must not be an issue for you. It is just a copy and a paste exercise. Moving to fixed cost. Fixed cost in the first year are how much? Fixed cost in the first year are 8 million, and they will increase by 5% in each of the years. So in year 1, they are 8, then you increase it by 5%, then you again increase the value by 5%, and then you again increase the value by 5%. And then the residual value is taxable in this case. The question stated that the entire amount or the sales proceeds or the residual value is going to be taxed as it is. You will have to pay a tax on it. So are you guys clear till now? These are simply copy and paste from the question. Nothing difficult at all. Contribution is mentioned in the question. Fixed cost 8 million is mentioned in the question. You just need to increase it by 5%. Residual value mentioned in the question. Yes, it is okay to manually input as well. Okay. Now let's talk about tax. Okay. Now very, very important disclaimer. Very, very important disclaimer. I will re-show you the sheets, but I sent a lot of files in the start of the session describing different possible treatments of taxation. Do you guys remember? Do you guys remember? I shared different files for tax treatment. Option number 1 is that you do the tax treatment separately and just input the taxation amount. And option number 2 is that you incorporate the tax workings in the same main working. So first, for this question, let's do it in both ways. You can see an alternative working. Okay, I have done this question twice, both in different manner. So don't worry, we are going to discuss both the methods of tax treatment. First, let's focus over here in step 1 and step 2. Now let's calculate this taxation. Let's calculate this taxation. For this taxation, I have done working in step number 2. So let's move to step number 2. Can you guys see step number 2? Can you guys see step number 2? Okay, let's see step number 2. Let's try to understand step number 2. Now, what actually happened at year 0 is that you did initial investment of 60 million, and the tax authorities told you that you have tax allowance 100% tax allowance in year number 0 as soon as you bought the machine. Generally, this is not the case. Do you guys remember that generally we put a percentage of depreciation, and the depreciation is charged in each and every year? But over here, you were not provided depreciation rate. They told you that if you invest initially 60 million, entire 60 million can be claimed initially in the first year or as soon as you do the investment. Okay. So this 60 million is the investment amount. Now, actually, the tax authorities are saying that till 60 million profit, you will pay no tax on this project. Second thing that the tax authorities told us, now tax cases will be different in every question. If you read over here, it says that tax losses must be carried forward. Tax losses must be carried forward and offset against profits from the same investment. Same investment means the same project. Now, actually, what the tax authority said that if you have a profit, you will not pay tax if it is below 60. So, for example, in year number 1, what was your profit? In year number 1, your profit was 16. Agreed? Contribution of 24 minus fixed cost of 8 leaves you with 16. Will you pay a tax in year number 1? Will you pay tax in year number 1? No. Why? Because you have unclaimed tax allowance. A tax allowance that has not been set off against the profits. So actually the tax authorities is saying that, for example, in year number 1, if you have 16 profit, but you had 60 carried forward losses, so you will not pay tax until these losses are adjusted against future profits. It is an advantage that the tax authorities give us. They tell us that if you are setting up a new business, there might be losses initially. For example, over here, there are losses of 60 million. So they are saying that your first 60 million income will not be charged to any tax. We want to encourage you so that you proceed with the project. Do you all agree? So out of 60, I claimed 16 over here. I paid no tax because profit was 16. I had carried forward losses of 60, which I used to adjust it. Now I have 44 losses with me remaining. I can still claim $44 million losses in the coming years, in the future years. Are we all clear? Again, okay. So this 60 is not a, this is initial investment as well. This is your initial investment as well. 60 is two things. Firstly, 60 is initial investment. Secondly, as per this question, tax authorities said that 100% of your initial investment will be treated as a depreciation immediately. 100% amount will be treated as depreciation immediately. And since there are zero revenues at year 0, if you have 60 million depreciation, you are in a losses. Understood, Saklan? This 60 is loss as well. This 60 is initial investment as well. Okay, now you have 44 left over. In the second year, you earned an income of 33.9. Again, your previous losses are 44. So you told tax authorities, we are not paying tax. No tax, no tax, no tax, no tax, no tax, no tax. Okay? No tax, no tax, no tax, no tax, no tax. Okay? We are not paying tax because we still have 44 million losses with us. Then still you are left with 10.10. Now in the third year, you have an income of 31.28. Incomes are calculated over here, okay? If someone is worried, where did these incomes, where the hell the incomes came from? Okay. So now from 31.28, you are able to reduce it by 10.10, and now you have to pay tax on 21.18. Okay, 21.18, which means that first 60 million income was exempt from tax, but now you have to pay tax. And at 21.18, if I pay 20% tax, it is 4.24. And then in the fourth year, there are no unclaimed tax losses. So you will have to pay tax on the entire amount. And if you pay tax on entire amount, it is 5.97. Sir, please, how was the realizable value accounted for in the tax computation? This is tax computation. This is tax computation, dear. The tax authorities, if you read the question again, the question states a tax allowable, a tax allowance of 100% is available immediately on this investment, which means that as soon as, okay, realizable value, that is being taxed separately. Wait a moment. That is being taxed. This 29.84 includes the realizable value. How? Let me show you over here. Can you see 29.84? 29.84 is made up of contribution, less fixed cost, add realizable value. So when we are taking 20% tax, we are paying tax on realizable value as well. Okay. Now what I did is that I did tax working separately. There are two methods, even more than two. One method is that you do the tax working separately. Another method is that you do the tax working within the main working. But let's go method by method. Let's understand things one by one. So under this method, I did the tax working separately. So I got the two tax amounts. They are mentioned over here, 4.24 and 5.97. Then we have cash flows after tax. Initial investment is 60. Okay. And then there is working capital. Okay, working capital was supposed to be how much? 10% of sales revenue at the start of each year. Working capital was supposed to be 10%. Working capital was supposed to be 10% of sales revenue at the start of each year. So let's go to the working capital. Working. Sales revenue at year 1, year 2, year 3, year 4 is given. Working capital is supposed to be 10%. So 10% of 60 is 6. 10% of 86.4 is 8.64. And then 10% of 77.80 is 7.78. But you were supposed to make these the investment of working capital at the start of each year. So for example, 10% of sales revenue, year 1 sales revenue is 60. 10% of 60 is 6. But you need to invest. You need to invest this amount. You need to invest this amount at the start of year, which means at year number 0. Do you all agree? So that's why in this working, you can see 6 over here. Agreed? Okay, now come to the second year. Now you need 10% of 86.4, 10% of 86.4, 10% of 86.4 is 8.64. But you already have invested 6. So additional working capital required is just 2.64. And it is needed at the start of second year, which is year 1. Then there was no further investment in working capital because the sales revenue for both the years were absolutely same. So you actually needed 8.64 and you had those 8.64 with you. Okay. You already have invested 8.64 in the working capital. So again, over here, there was no change. Then there is a reduction in sales revenue. Reduction in sales revenue means you need lesser amount, you need less investment in working capital. So there is a release of fund. 8.64 minus 7.78, there is a release of 0.86. So this is the release of 0.86. And finally, in the last year, all the remaining working capital is released. And which is 7.78. It was also mentioned in the question. If we read the question, it says working capital at the start of each year is expected to be 10% of the expected sales revenue for that year. Any remaining working capital will be released at the end of the project. So if at the end of the project, if there is unreleased working capital, that is going to be released as well. Are you all clear? Okay, then you have cash flows. And now one important, in the recent, you can see that ACCA is calculating discount factor rather than using the NPV formula. Have you guys noticed this fact? ACCA is using discount factors in recent past paper solutions rather than the NPV formula. And some students, if you listen to interviews of high achievers, for example, in September 2024 research orientation, you all must listen that 30 minutes session. I interviewed Rama Lakshmi, who got national position in Sri Lanka. She told the students that many functions in the exam Excel are not available. So to be on safe side in your exam, do net present value like this as well as use the formula. Most likely the examiner wants to see discount factors as well, because this is what is incorporated in their suggested answers, suggested solutions. Even if we check June 2024 past paper answer, they have calculated discount factor. Now, I don't know what is the purpose, but they have. So I decided that now I will request you all to do the working twice. Calculate discount factors, multiply them, and calculate NPV, and also use the formula. Do both things to be on safe side. Okay. IRR, I cannot say. I haven't seen anything. But for NPV, I just noticed it. Yes, Mevish, this is a you can say confusing point. But if they are doing something in their suggested answers, we must also do that, correct? We cannot just put the NPV formula and come back, because their suggested answer is showing discount factor. So to be on safe side, do both things. Do the formula thing as well. Like you will just need to add one more line and calculate the discount factors and multiply them with the relevant discount factors, and then add up to bring the net present value as well. Okay. It will not take you much time. Better safe than sorry. Correct? So do both things. Okay. Now, is this clear? NPV of 14.80. In this specific working, I did the tax part separately. I did the taxation workings separately. Are we all together? Okay, now there are various alternative methods I am going to share. I am going to broadcast a lot of files. Those are available on the Google Drive as well. So your broadcast lists are going to be absolutely jam-packed now. Do make sure that you have saved my number. To receive broadcast message, it is important that my number is saved with you. Okay, I have done an alternative working in which there is no need to do the text working separately. That particular separate working, the text working is inbuilt, incorporated over here within the main solution. Okay, so the initial part are same, contributions and the fixed cost and the realizable value are same. Okay, then you come up with cash flows before tax. Then you incorporate the tax workings over here. Like you do the offsetting losses in the main working. Okay, so there are two methods, more than two methods, but right now we are discussing two methods. What was method number one, in which we did tax working separately? which I just explained. And then second thing, some students prefer doing the text working within the main working. Okay, both are acceptable. Both are acceptable. Both are doable. Both will give you professional marks. How many of you find the first one better, in which we do text working separately, and how many you feel that the second one is better? I hope that by now you all have done some questions from both methods. Okay, so people have their preference. But if you are going with the second working, but if you are going with the second method, do make sure that you add back the carried forward tax losses. This is a non-cash adjustment that you made just to reduce your taxable income, but then you will need to add it back as well. This is an important critical point that you must remember. Likewise, in case of depreciation, if you are doing a single working, you will subtract depreciation above and then you will need to add it back. Okay, so there are two possible methods and you can use any of the possible methods. Okay, you all have this Excel file. You can go through both the methods very easily. Okay, I can explain tax losses once again. Do you want me to explain the tax losses concept again, or do you want me to explain the tax losses treatment in this second working again? What is your query actually? Okay, tax losses treatment. Okay, tax loss is a non-cash expense. Okay, you did subtraction of tax losses over here. You subtracted tax loss over here. Why? To reduce your taxable income so that tax is accurately applied. But it is a non-cash item, correct? In net present value calculations, all your amounts are cash flow based, correct? So since you subtracted it, you also need to add it back once again. Okay? It is just like depreciation that we have already discussed, just like that depreciation. Okay, are we clear till now? Any confusions? Anyone with any confusions? In method one, we do not have to add it more. No. In method one, we don't need to add it back because we never subtracted it. Okay, in method number one, we don't need to add it back. Why? Because we never actually subtracted it. So if you are not subtracted something, why will you add it back? Okay, let me go to the tax losses once again. In the question, it was stated that if you have tax losses, you can claim it in future years, correct? So you had tax loss of 60 million. Do you agree? And the profit for this first, second, and third year were 16, 33.9, and 31.28. So the question is actually telling you that if there are tax losses, you can reduce your taxable income for future years. Sir, in second one, why we add 60 in 2 times? We have not added 62 times. There are some formulas that are applied. Okay, no. If you check the formula being applied over here, losses carried forward line is not taken into calculations at all. Okay. Once I share this file, you can go over this file. Okay, once I share this file, you can go over this file. All right. Are we all clear? Any doubts till now? Now, this was your first part. Now, second part was about VSOP model. Second part was about VSOP model. Evaluate using the Black-Scholes option pricing model whether Little Brady Company should proceed with the investment in the furniture and equipment for schools and universities. Now, you in the scenario were given some amounts. You were given exercise price. Exercise price is the amount that you will need to further invest in order to avail the opportunity. So the question stated that you will need to invest 80 million if you want to go for the option to expand asset price. Asset price is the present value of the future cash flows brought today. So this was already given into the question, which is 52.7. Risk-free rate of return, R, is 3%. Now, how many of you have used the BSOP calculator? Is there some student who has used BSOP calculator? Any student who has used BSOP calculator, please tell me. Okay. Tell me, in a BSOP calculator, when we are putting R, when we are putting the value of R, do we put it as 3% or 0.03? Yes, I am going to do it live, 0.03. Again, volatility, which is 25%, will be put as 0.25. And exercise date is 4 years. These variables were given to you. Let's move to the BSOP calculator. You don't need to worry. Everything is ready. This is a game changer. So you have to just wait. Let me share the screen and show you the BSOP calculator. Okay, so on your screens, you have BSOP calculator now. Now tell me what was PA. Tell me what was PA in your question. What was PA? Value of PA. Can someone tell me the values? Was it 80? 80 was, I believe, exercise price. Asset price was 52.7, isn't it? Asset price is 52.7. 52.7. PE is 80. R was 3%, which is 0.03. Time was 4. And your S was 0.25. As soon as you put these values over here in the calculator, you get all these answers automatically. Can you see it? Okay. There were 4 years. Volatility 25%, which is 0.25. Risk-free rate 3%, which is 0.03. Exercise price 80. And the present value of income streams or the asset price today was 52.7. As soon as you put the values, I am using the official ACCA practice platform, and I just punched the values in front of you. And as soon as you do put these values, you come up with the answer. It is in front of you. You all can, during the break, you all can visit the BSOP calculator, go to your practice platform, go for a blank sheet in AFM and use the calculator. Okay, you simply put these values and you will get the call and the put option values. Now these two values will be given, but you will need to decide which value you have to use. Okay, this is something that you need to decide. It might be the call value, it might be the put value. This is your decision. The calculator is going to give you both values. These are irrelevant for you. D1, D2, ND1, ND2 are irrelevant. Previously, we used to manually find the values from the BSOP calculator, manual working, but now the calculator is in front of you. You put the variables and you get the call and the put option values over here. Okay, all clear? PE is the investment that you will need to make if you want to avail the particular opportunity, which is exercise price. Yes, the BSOP questions are very limited and the recent questions are very simple. Previously, it used to be very complex. Yes, we are going for call option. Now, whether it is a call option or a put option, you will read the 67 pages booklet. There is one summary page which is 4 different options describing why a certain value is a call option and why a certain value is a put option. Okay, how to prepare this topic? If you check secret sauce, I have identified 2 to 3 past paper questions relevant to BSOP. You watch the video lectures on the portal, you do those past papers, and in the 67 pages booklet, there is a 1-page document which summarizes when you will do a call option and when will you do a put option. How to interpret the values? This is the exercise price. If you go for the option, this is the amount that you will have to pay. This is the today's value or the present value of the cash flows. This is the risk-free rate, number of years after which you will exercise the option, and this is your volatility percentage which is given as it is. D1, D2, ND1, ND2 are irrelevant for you. These values were previously relevant. In the previous papers, we used to, like before the introduction of BSOP calculator, we used to find D1, D2, and then ND1, and then ND2, and then manually using a standard deviation table, we used to find the value of the call and the put option. But now these 4 values are not relevant for you. The only relevant values for you are the call and the put, and then you will decide which value you have to use. This you have to decide. Okay, are we clear? Can I minimize the BSOP calculator now? Okay, so moving back, this is the BSOP working that we were supposed to do. Okay, and then one more thing, we have to go to the ACCA answer as well. Wait a second. Okay, but after getting the put and call value, what to do next? Okay, the next thing to do is to decide whether in your specific case the relevant value is a call value or the relevant value is a put value. Sometimes the relevant value that you need to use is a put value. Sometimes it is a call value. Over here, it is an option to expand. In case of options to expand, call value is relevant. And actually, this is valuing, this is giving a value to the NPV that although the current NPV is negative, but there is some value which can be derived from future projects. Okay, so let me read it over here. The option to make a follow-on investment is a call option. So according to the BSOP option pricing model, the value of the option to make a follow-on investment is approximately $5.1 million. Overall value 5.1 million minus 7 million. Over here, our net present value was negative 7 million. If we incorporate the value of the real option into our answer, it is still a negative 1.9. The investment is still as a negative net present value despite the options, so should be rejected on those grounds. Are we now clear? So whenever you get the call and the put option, you adjust your net present value with this particular value. No, Khalid. Things have become simple now. You just need to use the BSOP calculator. Are you all okay? Okay, Safan, as mentioned, 67 pages booklet. Use the BSOP page, the summary page. You will get to know about option to delay, option to expand, okay, option to abandon. Okay, 5.1 is a real option value. Do you understand what is a real option? Okay, 5.1 tells you that although this project is giving you a loss, but the future opportunities that are associated with this project have a net worth of 5.1 million. For example, try to understand it like this. Sometimes you do a small project for someone knowing that it is a loss-making project. Why? Because you expect that afterwards you will probably get repeat orders. Understand? I repeat, sometimes you do a loss-making project for a certain client. You know that your investment of time and your costs are more and the benefits are less. Still, you accept that particular project. Why? Because you know that if you do a particular project of particular work, there are chances of a repeat order. So in this scenario as well, your original net present value is negative 7 million, which means although you are standing at a 7 million negative position, but you know that if you do this project, there are further chances for follow-up projects, and the values that will be derived from those projects will be worth 5.1 million. Are we clear now? Okay. So let's move on. We did this particular working for net present value. Then we did this particular working for the VSOP model. Then there is theory again. Okay. So what was the theory? Discuss the, okay. Theory was for question number, we are doing question number uh, 2. A1 and A2 are done. B is discuss the extent to which the investments in furniture and equipment for schools and universities will represent diversification for Little Brady Company. Discuss the extent to which the investments in furniture and equipment for schools and universities will represent diversification for Little Brady Company, 5 marks. Now, what is a diversified business? Diversified business is a business that is doing different projects. Over here, the company was delivering furnitures and similar products to offices, and now they are moving to schools and universities. Although in case of clientele, there is a diversification, but in terms of product, there is no diversification. Agreed? So actually what is written over here is that product development and market development. Market is market development and product development. Okay. So they have discussed two diversifications. Supplying schools and universities will represent a limited product diversification by producing some different products to what will be supplied for offices. You are already supplying the same furniture. Obviously, the nature of the furniture or the structure or the design or the shape will differ, but not too much. However, Little Brady Company will remain a supplier of furniture as it is for offices. They will still be known as supplier of furnitures. They are currently supplying furnitures to offices. Now, if they supply to schools and universities, although there is a new clientele, there may be some slight change in the product, but overall they will still be called suppliers of furniture. So there is no significant product diversification. For both the schools and offices, supply will be a combination of replacing existing furniture and equipment for current buildings, which is likely to be a steady market, and supplying new furniture and equipment either for new buildings or because of technological developments or other factors affecting what customers require. Market development. Supplying schools and universities is a different market from supplying offices, but how much this represents effective diversification will be determined by how much demand in these markets is influenced by the same factor. Okay, there is one type of diversification that previously your clientele was purely the offices. Now your clientele is offices and schools and universities. So in terms of clientele, you have probably diversified. To some extent, economic circumstances will determine demand in both markets. Poor economic circumstances will limit new office buildings and demand from existing offices, and may also limit government tax revenues, capping the amount which can be spent on education. Okay, there are various things written over here which you can read, but I believe that now you can write theory a much better. Okay, because in this question you were supposed to think this way, that is your business diversifying, are you moving towards something new? So you know that you are moving towards new clientele, new market, new types of customers, but there is less product diversification. Agreed? Okay, then a 4 marks question which says advise Little Brady Company on what changes to make to its reporting to provide more information about the rationale for and the factors affecting its future investment strategies. So you were supposed to discuss if you are disclosing sufficient information or not. You can go for integrated reporting maybe. So it says as a first stage, liability company needs to communicate better with major shareholders to find out what their requirements are. These may result in liability company producing more information than legislation and the governance code requires. For example, more details about the impact of government decisions about education on the demand for its products and more performance indicators than are currently shown in its annual report and business review. Likewise, you can read this properly. I am very hopeful that you will be easily able to reproduce. You just need how many marks? You just need 4 marks. Are we all clear for the second question? Is there any doubt? Okay. So again, let's take a break. Let's take a break so that you all can revisit the same question, which is question number 2, and ask me questions, and then we will come back and we will see if we can probably do the third question as well. Okay. We will probably move to the question number 1. What do you guys say? I believe we must, isn't it? Let's get done with this exam paper. Okay. So okay. Giving you guys, let's take 15 minutes break, then we will decide what we have to do. So it is a 15 minutes break again. It is 10:57 right now. Let's meet after 15 minutes. So we will be meeting at what time? 10:15. Okay. All right. Let's meet, sorry, 11:15. 11:15. Okay. Let's meet at 11:15, like around 18 minutes from now. Let's see. Maybe we will start the third question today or we will do it tomorrow. Okay. And those who have just joined, do WhatsApp me so that I can save your numbers, and afterwards, this is your time to recap question number 2. I don't need any doubt from question 3 and question 2. And then we will move to question number 1. Okay. Thank you. Okay. So is my voice audible to everyone? Now let's do one thing. Let's solve question number 1 tomorrow. Okay. Let's solve question number 1 tomorrow, not today. But do you guys have any doubt in question 2 and question 3? Do you guys have any problem in question 2 and question 3? Same time. Tomorrow's class is going to be on very same time. Okay. Sir, how advancement and furniture will lead to diversification? Okay, not to greater extent, but obviously if they are currently focusing on one type of furniture only, if they make 2 or 3 different types of furnitures, to some extent they will diversify. Okay, advice, in this case, advise little breedy company on what changes to make. No, you give suggestions actually, because over here they were giving a very limited information. So it is an open-ended question, not only pros and cons, it is like a suggestion or what actually the company must do, which they are not doing correctly. So take it at its literal meaning. Anyone else? Okay. Now you all have the secret sauce. Those students who are not enrolled, do make sure that you WhatsApp me right now so that I can add you to the relevant WhatsApp group. And once you are added to the relevant WhatsApp group, I will be resharing the secret sauce and other documents. Most of the theory, 50% common sense, yes, correct. To be discussed with number for questions, yes, correct. So what I am doing right now is that if there is someone who is outsider, who is not our regular student, do make sure that you are added into the WhatsApp group. I will share you the link to the booklet and other documents, and everyone, I hope, has the secret sauce with them. Anything else that you guys want to ask me, please let me know. First, I'm trying to add the students in the group that I have made where I'm sharing content. And then I will share it. Okay. All right. All good. So see you tomorrow. Tomorrow's topic is the question number 1, which is relevant for the hedging area. So I hope you all will be present tomorrow. Tomorrow's class is going to be very important. Before tomorrow's class, do make sure that you recap and revise all the hedging concepts. And we are going to do that particular area tomorrow. Okay? Yes, please revisit question 2 and 3. Don't prolong. Just wind up this 2024 paper. You already have all the previous past papers on the portal already. Okay? Second, we are ending the session because a lot of students on my WhatsApp told me that they are tired. They don't want it to be further. They don't want it to start like question number 1. They want question 1 to start tomorrow. So we are going to do it tomorrow. Okay. All right. So keep preparing. Same time tomorrow for question number 1. Same time tomorrow for question number 1. And question number 1 has forex, options, hedging area. Okay. So it is exchange rate hedging and similar area. So we are going to do it tomorrow. Thank you. Bye. New students, do WhatsApp me. Okay. Thank you. Bye. Allah Hafiz.